So this morning, the Federal Reserve announced that they were going to do a big quantitative easing. Last night, Dow futures were limit down almost like 1,000 points. This morning they rallied a bit, and it actually went almost positive for a little bit, but then sold off a little later in the day. But what's the effect of this, and what exactly does that mean? Well, what it means is that they're going to be buying up all kinds of crappy assets, or assets that all these hedge funds and all of these other people cannot sell, and it is gunking up the bond market. So like in the financial crisis, they're going to let these people sell their bonds back to the Fed and any kind of other crappy assets, to the point where they are now also going to buy back corporate bonds, including ETFs like LQD liquid. And you see that ETF has jumped up a whole bunch today because it has really been going down, and its net asset value was even 5% lower than where it was trading at, 5% lower than its net asset value. So there's really some crazy stuff going on there. But is this a good idea? Should the Fed be buying back people's crappy assets and giving them good money for it? That stops the market from finding the right price, and price discovery, as it's called. So for instance, if this trailer right here is worth 20 grand, but you're able to sell it back to the Fed for 30 grand, then that stops somebody from actually looking to buy it at its real price, 20 grand. So it just extends the problems in all of these markets. And that's what they did during the financial crisis in 2009, and now that's what they're doing again here. And so another example is, these cars. If a car is worth 2 grand on the open market, but you can sell it back to the Fed for 3 grand, then you're not going to sell that car for 2 grand. So the true price of the car gets inflated, and the real people who would have bought it at 2 grand don't get to buy it because the Fed has it now. And who knows how long they're going to keep buying back these crappy assets like that. Another way to think of it is, during a financial crisis, the banks held these mortgages of these houses that were sold to people that couldn't afford them, and they were overinflated and all that. So they have these houses that maybe they bought them for $500,000, but after the crash, maybe they were worth 30% less. So instead of the banks marking down their mortgages, the value of their mortgages, the mark-to-market value, meaning the market value today, down 30%, they didn't do that. They called it extend and pretend. So they just pretended that it was still worth 500,000, because if they marked them down to where they were really worth, they would be insolvent. And so the Fed bought back a bunch of these mortgages. It's kind of like, let's say the banks were importing brand new $100,000 Mercedes from Germany in a cargo ship, and along the way that cargo ship ran into some rough water, and some of the cars got some water damage, some of them got scratches and dents. So those $100,000 Mercedes weren't worth $100,000 anymore, but the banks kept them on their books as if they were worth $100,000, and they were able to sell back a bunch of these mortgages to the Fed for that $100,000 value, let's say. And so this is the problem that we're facing today. You got a scooter like this that maybe is not worth a lot, but they could sell it back to the Fed for some ridiculous amount of money, And that's what's happening. And it's a slippery slope, because that's what happened in Japan and what is happening in Japan, to the point where not only is Japan buying back bonds, but they're also buying back actual ETFs, stock ETFs. And the Fed's mandate is they're not allowed to do that, supposedly, although many people have said that they have secretly been doing that, you know, with their plunge protection team and all of that stuff. So, but they've never come right out and said that they would do that. But now that they're buying, they could buy the liquid ETF. What's to stop them from start buying other ETFs as well? And the funny thing about these corporate bonds that are like in the LQD ETF, these are the same bonds, or some of them are, that were floated by the companies that were selling debt to buy back their stock, selling debt to fund their dividend. So it's like they're borrowing money to pay off the current people, the stockholders and the executives, with higher stock prices and higher dividends. And then when it's time to pay back that money on the bonds, they say, hey, our bonds are trading too low, we need a bailout. So, you know, let the Fed come in and buy that all from us. So really crazy stuff going on right now. And you know, the bond market, LQD went up a bunch today and everything, but it didn't solve the problem. People had that initial kind of gut reaction, rip up in price, but then it came back down. So, you know, is this gonna last? Who knows? But, you know, I don't know. But they're really trying to just reflate everything back up. So there will be a time to buy, but I don't know if that time is now. Like I said, I want to wait until things are worse, when earnings come out and all the companies revise their earnings lower and stuff. So I would just keep watching, wait till there's like maximum fear, and then maybe start dipping into some of these stocks. You know, the more solid stuff, stay away from the speculative stuff. Why buy the third tier stuff when the first tier stuff is on sale a lot? So that's how the rich people make money. They wait for stuff to go on sale a lot, and they buy and they sit and they're patient. But you know, one thing that they have that we don't have is the Fed to bail us out if our decisions are wrong, and we need somebody to pay higher prices for the assets that we bought that are now collapsing. So, and one thing that that kind of the opinion of what the Fed is doing can be reflected in the gold market and silver market, because gold was up like $77 today. So in other words, people are realizing that the Fed wants to just reinflate everything and paper over everything like they did in the 2009 financial crisis. And a lot of people will debate if we ever really got out of the 2009 financial crisis, or do we just kick the can down the road and paper it over until something like the coronavirus comes and pops the pin on the bubble market that we have. So it's going to be an interesting next few weeks. if people start to believe some of the crazy stuff that people are saying, like Cuomo talking about a 9-month quarantine or something like that, that's going to be reflected in the stock market and everything else, because you can't shut down a country for 9 months. We'll be back to you know, hunter-gathering if it comes to that, or actually, yeah, I don't want to say what's going to happen, but you really can't shut down an economy for 9 months like that, or even a few months. So let's hope that these numbers in Italy, which have been going lower in the last few days, are the trend, that the worst is over and it's peaked in Italy. We'll see, but the numbers have been going down the last few days in terms of new deaths and new infections. So keep an eye on that, and keep a list ready of the stocks you want to buy before the market turns. And like I said, I don't think it's turning that quickly or anytime soon. It's not going to be a V bottom. Wait till more bad news comes out, but have an eye on the stuff that you want to buy. So that's my video on the Fed's quantitative easing today and what effect it could have on stock markets, bond markets, gold and silver markets, and what you should be thinking about in terms of keeping your powder dry and getting ready to start buying stuff up eventually. But again, Goldman Sachs came out and said S&P could go to 2,000, and based on different PE ratios and earnings, you could see S&P 1500. So it's not out of the question, especially because everybody, just like markets overshoot to the upside, markets overshoot to the downside with heavy pessimism. So when you see that big heavy pessimism where nobody's no longer saying buy the dip and nibble on this stock and accumulate this one and dollar cost average that one, then we'll be closer to the bottom than we are now. So that's my video. If you liked it, leave me a comment. Let me know where you think the S&P will bottom out, and give me a thumbs up if you like this video, and subscribe to my channel if you haven't done so already. Thanks for watching.